Hey everyone, I'm Cary Smith and I'm sitting here with Amar Shah, and we're both with Client First Capital. And Amar, the topic that we have today, I think is on everybody's mind, and it's inflation. And when I say everyone, I think it's on everyone's mind, but it's probably on people who are about to retire or living in retirement that are thinking about it the most, right? Um, we've got a really good discussion going on today about how to secure your finances against inflation, right? But geared towards retirees. And
Yeah,
so, with that, let's jump in and get started.
yeah, and I would just add that if we look at the last 3 years, the average cost of things has gone up roughly between 20 to 23%, depending on what you're
Hmm.
looking at. And I don't think a lot of people have had that built into their financial plan that things are going to get, there's going to be a bump up of 20% in expenses, right? And so it's probably a good thing to kind of look at and kind of reflect on what can you do from a financial perspective to help protect against inflation. And then also, how do you revisit this and how do plans change? Because nothing is constant, right?
Right.
So inflation, definitionally is just, the cost of a basket of goods, that the government looks at. It adjusts those goods as purchasing habits change, and it says, and it tracks those goods over a period of time, and it says, are they more expensive or less expensive, and kind of looks at that on a year over year basis, right? And so historically, we've been in a pretty low inflationary type environment. The last from COVID years till today, things have kind of changed in those terms.
Yeah. Okay.
Yeah.
So maybe let's just say a little bit about the unique impact on retirees, and I think you set up the definition real well. But retirees are a little bit unique in the sense that their earning power, they're not really earning income, and so they don't have the ability to improve their earning power necessarily. And so if you're retired and you're living off a fixed income, pension, Social Security, those sorts of things, they may not be changing as the price of goods are going up, and therefore your spending power is being reduced.
Yeah. It's something like 80% of retirees, Social Security represents 70% of their total monthly spend, right? So definitely impacts a lot of people, right? And so when you have fixed income, uh, you have to look on the other side of the equation of the variable income and income that can be adjusted with inflation. And a lot of those things that you need to invest in have some sort of risk associated, right? It's not like your fixed bond or your CDs where you know what you're going to get in a specific rate. These are products that have, you don't know what the rate of return is going to be because there's a variability component to that. Um, you know, for retirees, healthcare, housing, daily expenses like groceries are going to be somewhat of an impact. And even when we look at housing, a lot of individuals say, "Well, I own my home in retirement. I don't have a mortgage. My rent, I don't rent, so that rent component of the CPI equation is not there for me." But the maintenance and repairs and all the other parts of owning a house
Mhm.
are there, and those costs are going up, right?
That's right. That's right. And and I think we're all kind of accustomed to this, but there's times where you just need to manage your expenses a little bit better, right? And there's maybe some items you just, hey, I'm not gonna indulge on this. I'm gonna plan my trips. I'm gonna just be a little more frugal where I can, right? So we do kind of tightening the belt is one of the strategies, I guess. And you hope that you can do that without compromising your quality of life, right?
Right, exactly. So, budgeting is a big part of
Mm-hmm.
retirement planning, and when you're in retirement, it's one of the variables that you can control. Healthcare costs. You'll be amazed at how many healthcare bills that we review with clients, and that there's so many errors on those healthcare
Yeah.
bills, right? And I know there are new companies coming out there. I think Mark Cuban has one that's coming out where you can compare prescription drug costs from different vendors, and
Mm.
like you can save thousands of dollars on the healthcare expense just by looking at what a treatment costs at one hospital versus another, right? If it's non-urgent, there's a lot of opportunities there. But I also think like tax efficient withdrawals, figuring out where you are in your adjusted gross income brackets, and then saying, all right, if my taxable income is here, you know, how much room do I have in this bracket? Or if I'm above that bracket, where is the next bracket, right? And looking at that piece of the equation as well.
Yeah. Hey, if I could take just a half step back on healthcare cost, if you're on Medicare, um, and you have Part D prescription drugs, it's also worth it to take a moment every year and review that plan and see if you have the best plan, the best price, the plan that's covering your drugs the best. And you can make those changes during the annual election period, Medicare AEP, which actually is coming up. It starts October 15th and runs through December 7th. But that's at least a moment that you can look and see, can I reduce how much I'm spending on drugs?
Yeah, no, absolutely. Um, and I guess the next part is just protecting your savings, right? And protecting your savings really comes to two pieces. One is that most retirees are more conservative than they need to be, right?
Right.
And so you need to take on risk in retirement. Numerous studies that show that. I know it's hard to take on risks because there's kind of like a timeline that you're looking to make sure that your funds last, and you don't want that variability in your portfolio. I think one thing that most people can do to help protect against that is to make sure that you have a large enough financial emergency fund, cash reserve that covers more than just 3 to 6 months. We're talking 18 months, even 2 or 3 years, where that way you can weather the storms in the market so that you're not touching those investments when they're down and causing further stress on your overall portfolio, right? So looking to make sure there's enough cash buffer before you actually touch your financial investments, I think is big.
Yeah, and I would add that taking on more risk is not the same thing as being risky, right? And so you can smartly take on some more risk without really putting your financial future at risk, so to speak. And so this is an area where, if I'm doing this, I'm probably more comfortable working with someone, right, who's giving me some good investment insights or strategies.
Yeah. One of the ways that we do it, Cary, and maybe this is just a plug or a shameless plug of how we adjust risks, is that we contextualize the current environment, and we can back test all the different asset classes, and we can see how they perform from a risk adjusted perspective. And you'll be surprised to know there are quadrants between growth and inflation where bonds have been more risky than stocks. And then there have been quadrants where you can take on the extra risk of stocks in a portfolio and make sure that that helps your overall risk profile be reduced, right? And so it's something that you want to update and adjust according to your plan, right?
Yeah,
So
that didn't sound shameless at all, but it was some good insights.
yeah. Let's wrap this up with just long-term planning and monitoring. I think one of the keys in being successful over your retirement or someone's retirement is to make sure you do a financial planning at least annually, because then you can get think of a plot chart where you can plot your points of where you are in terms of success in retirement, and as long as you're staying within your zone, then you're good. If you go outside of your zone that you feel comfortable, then you need to make some changes. I think that um, at least annually, if you track that, then you got enough plots dots on the chart to know which way you're trending over 3 to 5 years. And then it's also important to look at that and say, wow, our safety, we have more than enough for our safety and margin. Should we be allocating dollars from a legacy perspective to our children in their risk tolerance, right? In their time horizon, and ways that we can help them. So,
Okay, Amar. Hey, so there's a lot to talk about when it comes to inflation, and I think that we've covered a lot of the key aspects of retirees dealing with inflation and how you can set yourself up for success, right, as you go through retirement. So, with that, I'm going to wrap us up. And again, we're Client First Capital, and you can connect with us at clientfirstcapital.com. You can also, subscribe to this YouTube channel, right, and get videos like this and additional videos. If you have any questions or want some help in planning, just reach out to us. Be happy to work with you.
Yeah, sounds good, Cary.
All right. See you,
Bye.
Mark.